Hi, I'm Professor Bei Dong from USF School of Accountancy. Today, we're going to cover many topics related with revenue recognition. In this audio, we're going to discuss revenue recognition principle at point of sale. If a seller wants to recognize revenue at point of sale, the general rule is, first of all, cash needs to be realized or realizable. Realized means that seller get the cash from the buyer. Realizable means that seller are expecting cash is coming. Okay, cash is going to be realized in the near future. Secondly, it is the date the buyer takes immediate ownership of the goods, which means that the title is transferred from the seller to the buyer. Okay, goods and services are delivered. So if both conditions are met, then seller could recognize sales revenue at the point of sale. The journal entry is debit accounts receivable if cash is realizable but not realized, or cash if cash is realized, credit sales revenue. Of course, at the same time, if the seller is selling physical goods, they also need to recognize debit cost of goods sold, credit inventory, because the products title are transferred. What we have discussed is the general rule of revenue recognition at point of sale. This rule is subject to many factors, for example, shipping term. Shipping term decides the exact timing of the revenue recognition. There are two types of shipping terms. First one is FOB shipping point. FOB shipping point says that the title of the goods are transferred from sellers to buyers when products are taken by the carriers. Okay, so revenue recognition should be conducted. Okay, we should recognize revenue when products are taken by the carrier. The second one is FOB destination. FOB destination says that the title of the goods are transferred from sellers to buyers when products are received by the buyer. So that should also be the exact timing when we recognize revenue. So we can see that these shipping terms are very important because it decides when the title of the goods are transferred, which party pays for the shipping cost, and of course the timing of recognizing revenue. The second factor we need to consider when we recognize revenue at point of sale is this right of return. 6 requirements must be met before we recognizing sales revenue earning from those products with right of return. Number 1, price is fixed and known. Number 2, when you sell the products to a customer, this sales transaction is not contingent, not dependent on the resale of the item by your customer. This requirement rules out those consignment sales. Again, consignment sales is not sales, although it is called sales. Number 3, your sales transaction is not contingent on whether products are physically damaged or stolen after the sales transaction with your customers. Number 4, resale of the product does not affect the seller. Number 5, sellers are not responsible for the performance of the products. They are not responsible for the economic benefit the customers can benefit from your products. Number 6, seller can reasonably estimate future return, and this rate of return should not be significant. Okay. After all these 6 requirements are met, we can recognize revenue. When companies can estimate rate of return, okay, and this rate of return is small, they can recognize sales revenue, okay, and they deduct this rate of return from sales revenue. But if companies cannot estimate this rate of return or has high rates of return, they should wait till the rate of return expires and then recognize sales revenue. The third factor we need to consider is whether the sales transaction comes with a buyback agreement. Okay, so what is buyback agreement? This usually occurs between manufacturers and wholesalers. Manufacturers agree to buy the products back at a future point of time if those wholesalers cannot sell all of the products to the customers. So we can see that in a sense, those buyback agreement is very similar to a financing agreement. Okay, during this agreement, buyers or creditors, okay, they loan the money to the sellers and use inventory as a collateral. Of course, sellers are the person who actually get financed. Even during this, transaction, the title of the inventory is transferred from the seller to the buyers. Okay, so for those sales transactions with buyback agreement in accounting, there's no sales revenue should be recognized, okay, on the date of sales.